consolidation accounting at the end of the first year. You should have in front of you a three-part worksheet for December 31st of X1. In the previous learning objective, we determined how we got to income sub of $289,500. Now we need to go to the eliminating process so we can do consolidated financials. Our first EJE is going to be what we've done since Chapter 2, which is to eliminate the current year activity between the parent and the subsidiary. We're going to get this information from the book value schedule. We're going to get the $389,750, the $233,850 for the dividends. Now notice that we are not going to eliminate the $289,500, which is the amount that is in the income sub on the parent's records. We will get to that, but for now, the first EJE will always come from the book value schedule that eliminates the net income subsidiary, the full amount. The next EJE will be the subsidiary's book value. That's going to come from the book value schedule as well. We've done that since Chapter 2. Should be pretty familiar to you. We're going to debit common stock, $450, debit retained earnings for $400, and credit the investment for $850. The next thing we need to do is we need to take care of the differential. Not the differential we've used, but the differential that we purchased. If we go to our differential schedule, you can see at the initial acquisition we purchased some differential, which was the excess fair value over book value and the goodwill. During the year, we used some of that up. We used some of the inventory, depreciation, goodwill, etc. As a matter of fact, we used $100,250. Now, we still have some of that differential left, and what's left is at the end of the year. So we have to record that differential that remains on our records. Remember earlier we recorded the $800,000 at the end of the right after acquisition. Now we've used some, we're going to record what's left. And what's left was on the schedule, so we're going to make the entry as follows. Debit goodwill. I put inventory on here because initially we did the $59,000. It's no longer there. I'm just leaving it here just kind of as a reminder. Hey, it was there. It's no longer there now. We debited land. We debited building and equipment. And notice we did use some depreciation, the $36,400. We're going to set up a separate accumulated depreciation account to account for that. And after 5 years, that should equal $182,000, which is the excess fair value. We're going to credit the bond payable, and then we're going to credit the investment subsidiary for the total that's left. That leads us to the last group of items. The first EJE, we eliminated the income of $389. We have to account for these excess items that we had during the year, the cost of goods sold, the depreciation, and the goodwill. If we were to stop right now, this is what our income sub would look like. We made one EJE, $389,750. What's sitting in the parent's income sub is $289, and so if we did that, we would have a debit of $100,250. And we know that that should be zero. And what makes up the $100,000? We can see from the income statement that we prepared earlier that if we added up the cost of goods sold, depreciation, and the goodwill impairment loss, that equals the $100,250, and that's the total that was used on the differential schedule. Here's the unique thing about differential items. During the year, we use the equity method of accounting to record them. So if you remember back during the current year, we debited income from subsidiary credited the investment account. For consolidation purposes, we have to put them in their appropriate expense account because, one, we've eliminated the income sub-account, and we want to present an accurate financial statement when we consolidate. So here's what we're going to do. Remember that the $59,850 before this entry is still sitting in the income sub-account. So what we're going to do is we're going to reclassify it, and we're going to put the $59,850 in cost of goods sold and credit it from income subsidiary. It does two things. It puts that inventory in the correct expense account when it's sold, and it reduces the income sub by a portion that needs to come out of there to get it to zero. We're going to do a similar entry for depreciation. We're going to take the depreciation, put it in its appropriate expense account, take it out of the income sub for the full amount. Goodwill will be accounted for exactly the same way. So if we put all our journal entries on one page, what we can see is if we just focus on the income from subsidiary account right now, we see up there we have a debit of $389, and as we scan down, we get to EJE 4, 5, and 6. We have a credit there of $59,850, $36,400, and $4,000. Combination of all those brings the income from subsidiary account to zero. We can see that when we look at the consolidated trial balance or three-part worksheet with everything posted. If you focus on the income from subline, you see that it is zero through a combination of entries. We also see that the investment sub-account is zero, and we see that the asset accounts are written up to their fair value if they remain. Notice that the inventory is used, so we don't write it up again. The land still has a fair value of $133, so we write it up. Same for the building and equipment. The last thing we need to do is to prepare our consolidated net income. We're finally going to get to a few things that we've kind of pushed off in Chapter 2 and 3. And the first is the separate operating income we've seen before, but the main focus on this is that we're going to have some adjustments now. Here's what you need to remember. The adjustments are going to go with whom they relate to. In this instance, we purchased the inventory at fair value from the subsidiary, so that item is going to go with the subsidiary's net income. It's not going to be offset against the parent's net income. That's going to be offset against the sub. We'll do that for all those items, and we have an adjusted net income of $289,500, and when we add that to our separate operating income, we get $488,560. So if we were to formalize that, we'd have separate operating income $199, adjusted net income, and then consolidated net income.